Fidelity bond investing is a type of investment that involves purchasing bonds issued by companies or governments to raise capital. The bond issuer promises to repay the face value of the bond plus interest over a specified period of time. To start investing in Fidelity bonds, it is essential to understand the key concepts involved. A bond typically consists of three main components: the face value, the coupon rate, and the maturity date. The face value is the amount that the bond issuer promises to repay at the end of the bond's term. The coupon rate is the interest rate that the bond issuer pays to the bondholder periodically. And the maturity date is the date when the bond expires and the face value is repaid. The process of investing in Fidelity bonds begins with selecting the type of bond to invest in. There are various types of bonds available, including government bonds, corporate bonds, and municipal bonds. Government bonds are issued by governments to finance their activities. Corporate bonds are issued by companies to raise capital. And municipal bonds are issued by local governments to finance infrastructure projects. When selecting a bond, it is crucial to evaluate the creditworthiness of the bond issuer. This can be done by checking the bond's credit rating, which is a measure of the bond issuer's ability to repay the bond. Bonds with high credit ratings are considered to be less risky, while bonds with low credit ratings are considered to be more risky. To invest in Fidelity bonds, investors can purchase them through a brokerage firm or directly from the bond issuer. It is essential to work with a reputable brokerage firm that has experience in bond investing. The firm can provide guidance on selecting the right bonds, managing risk, and maximizing returns. In terms of best practices, it is essential to diversify a bond portfolio by investing in a range of bonds with different credit ratings, coupon rates, and maturity dates. This can help to minimize risk and maximize returns. Additionally, investors should regularly review their bond portfolio to ensure that it remains aligned with their investment objectives. In conclusion, Fidelity bond investing is a type of investment that involves purchasing bonds issued by companies or governments to raise capital. By understanding the key concepts involved, selecting the right bonds, evaluating the creditworthiness of the bond issuer, and working with a reputable brokerage firm, investors can make informed investment decisions and achieve their financial goals.